Jeffrey, you said that the term investor has been diluted over the last decade. What do you mean by that?
I think that the term investor has been diluted over the past decade because, frankly speaking, when you're looking at institutional investors or professional investors in venture, more and more what we have been seeing is people that have not operated businesses, that have not personally invested in businesses and taking on their own risk, climb the ranks of venture capital firms and then are sitting in a seat of power of deploying that capital. And I say the term has been diluted because now we have many clients sitting in front of those investors, having those conversations and getting feedback from non-operating partners at venture capital funds who control kind of the power of deployment of capital, providing feedback to founders who are desperate for that capital that isn't always constructive to them. So I think the term investor, when we talk about it being diluted, I think maybe we should even create separate terms for the types of investors we're talking to, where on one hand, you have operators, you have people who are GPs in control of capital and deployment of that capital, who have done and built businesses before that they can actually act as a strategic investor, versus an investor who's simply putting in money that is going to wait for that liquidity event coming out of a company. While both are technically speaking investors, I believe when we're talking to venture companies, venture-backed companies, or even founders looking for capital, they need to be acutely aware of the different types of investors that are out there. Strategic, purposeful, focused, collaborative, versus less strategic, just money, just providing them with access for additional runway down the road.
Could you tell the audience what IRR is? Most of our audience are founders. We do have investors, but most are founders. So I think it's relevant for them to know what IRR is.
So IRR is defined by internal rate of return, meaning for every year that goes on over the course of time, I'm looking for something that I can annualize to 20 or 25% return over the period of time that I'm holding it. So if an investment is held for 5 years and I invested $1, I'm looking that over the course of 5 years, that I can show a 20% annual return on that dollar that I invested.
Mm-hmm. Thank you.
And what's important to understand is that on the venture capital side, when they're underwriting to 40x return, they're doing that because of the inherent risk of who they're investing in, or rather what they're investing in. Earlier stage companies carry a lot more risk. There's a lot more chances of a company failing altogether, or maybe returning far, far less than their initial expectations were. So between the failed companies, between the companies returning far less than the expectation is, that's why I consistently have to underwrite to a much higher return, so that the ones that do give me a high return, such as this recent Canva IPO, that made up the entire portfolio of either losses or break-even investments that I've made. Whereas private equity, kind of alternatively, is typically investing in either later stage companies or more mature companies that have proven revenues, that have proven track record and proven progress, so that I know that I'm investing today and there's going to be this value add or growth add that happens over time. And again, I'm generalizing. There's private equity firms that are investing in turnarounds and buyouts and are making a lot more money than 20% IRR, and vice versa. On the venture capital side, there's plenty of funds that are underwriting to much less than 40x return, but their filters or criteria for the actual investment becomes much more narrow when they do that as well.
I want to dive into is that as an angel investor, how do you know, kind of how do you align your expectations, especially if you've worked in a corporate where there are departments and everything is organized and there are processes, and then you're speaking to a 5-10 people startup where that's just not going to happen?
Right. It's a really good point. I think this brings up an even broader point of expectations in general. I would say that a core tenet of ours at the firm, and we try to pass that to clients, investors, everyone we speak to, is to set proper expectations. If you're setting proper expectations on day one, it alleviates so many problems later down the line. So as an investor, if you're coming into a company and you'd like to invest in them and you have a certain expectation of financial reporting, of communication, of whatever your expectation is, throw it out the window as an expectation and at least ask. at least ask and set the expectation with the founder or with the management team or with your potential investment opportunity that you're looking at or the target that you're looking at. If you are expecting financial reporting, don't assume that just because you expect it and no one has ever spoken about it, that you're going to get those things. I think it's as much a fault of the investor in using you as kind of the anecdotal evidence. It's as much a fault of that investor to have had those expectations, never brought them up to you, and then became frustrated when the expectations that were never voiced are not being met. Now, on the other hand, yes, you're absolutely right. The earlier stage of company, usually the less sophisticated the reporting is. And as you grow, you start having reviewed financial. You'll eventually start having audited financial. You eventually have a full-time CFO who's not focused on fundraising, but more focused on cash management and financial reporting. So it's important to set the expectation also to the investor if you feel that they're expecting something that hasn't been discussed, for you to actually voice that proactively. I've seen so many term sheets actually that start outlining, we're going to be expecting a financial report from you every single month. We're going to be expecting these reports from you every single month or every quarter or every year or whatever the case may be. So it's important to outline those not only in conversation with your investor or from an investor with the potential target investment company, but it's also important to outline those in some sort of term sheet or legal documentation where it's not to handcuff them, it's not to put them into default, but to clearly articulate and outline exactly what the expectations are.
As far as I could see, we were the first government-funded kind of accelerator program that was asking for this, whilst everybody else was still asking for presentations. And I was seeing that investors have really, really moved on. And also what's good news, I think, for founders is that I'm seeing fewer investors saying, you don't have a CTO, come back to me when you found one. Because that used to be a huge, huge barrier. Is that what you are seeing in the market as well?
It's been less of an ask. I haven't heard that as a pushback from investors. What I will say though, based on what you had just said earlier, is forward progress. Forward progress has been incredibly both more prevalent and important for investors prior to them making a decision to deploy capital into your company or to make an investment. And what's really important to understand is that forward progress is not a measurement of a point in time, but rather over points in time. So from a fundraising perspective and an investing perspective, it's never too early to start raising capital. You always want to be out there introducing yourself, introducing your concept, your idea to investors. Maybe not necessarily raising at the time that you're reaching out, but building a relationship. And what investors will want to see is forward progress over the time that they've met you, if eventually you do want to raise money from them. And forward progress, and why I bring this up, is that going to them with saying, hey, all I need is money to build an MVP, that's not forward progress, because that just means you're stuck. And if no one gives you money, then you're not going to build an MVP. And if that's the mindset that you're in, that's never going to be conducive to a successful business. A business needs to constantly be iterating and moving forward in some way, shape, or form. And most products, by the way, many products, I don't want to say both, many products or services can be effectuated in a manual fashion. You don't need tech for every single project that you're building. Sometimes it's okay to think of a marketplace and just have 2 spreadsheets and just start the business. Because over time, you'll see what works, what doesn't work, and you'll be better informed about the type of product you want to build rather than, building a tech product for a market that doesn't really need that solution or that solution isn't applicable. So thinking about kind of going back to my point around forward progress, and even further back to when we were talking about the newsletters and you mentioned that helping you raise capital, sales 101 is that you need to have about 7 touch points with someone before you make a sale. Investment is not any different. So your first outreach to them, you schedule a call, you have the call, you send them 2-3 months of newsletters, and all of a sudden you're on 6 or 7 as a touch point. And that's when you're going to end up closing that investment. So going out to someone on a first call and trying to close them on that capital, maybe it worked in 2020, 2021, maybe it worked prior to that in certain edge cases or outlier cases, But if you're looking at the average, you're looking at best practices. Best practices will indicate you have to show them forward progress over time so that they're investing in forward progress, as opposed to I'm investing so you can hit go.